Now, of course, another big issue weighing on investors' minds this week at least has been China's Evergrande, the giant property developer there. It says it will make a coupon payment on domestic bonds today, providing some relief to jittery markets, which had feared a default could ripple through the global financial system. Let's get a view. Ned Bell, Chief Investment Manager at Bell Asset Management, joining us now live. Ned, good to talk to you. So, has this disaster in China at least being averted? Clearly Beijing stepping in here. So how are you looking at this at the moment as far as Evergrande is concerned?
Yeah, thanks for having me. So I think so clearly the immediate risk has perhaps gone on the back burner, but it doesn't really alleviate the broader risks that this episode has brought to light, which is that there is a huge amount of leverage obviously in the property development sector in China. And if that continues to slow, like I think most people expect it will, that has ramifications for global GDP growth. It's no secret that China's economy has been the backbone of global GDP growth for a number of years. And I think when you've seen these types of episodes before, it's very rare that you have one company gets into trouble and then that's the end of the story. There's usually several others to follow. The industry as a whole is very heavily indebted, and I think probably the big question that a lot of asset allocators are asking themselves now is just around how should they be thinking about risk within emerging markets as an asset class. It's obviously been a difficult place to be, and aside from the property development companies, obviously the likes of Ali and Tencent and the education sector have really come under some strain from the regulators. So the risk elevation in emerging markets, and particularly China, is very prevalent, and I think that's probably causing a few concerns.
Yeah, obviously, look, there's ongoing concern about the overhang they've got just as far as apartments are concerned that remain empty. I think it's about 25% of those new builds. But just as far as what Evergrande is owing, I think it's about 35 billion US to some 19 Chinese banks. So do you feel as though it is largely contained within China? There's not going to be much spillover effect just as far as perhaps what's owed outside the country?
I think that's right. I think it will be contained within China as far as the banks and from a credit perspective. I think the ripple effect that will extend beyond China will be that if we see, a faster slowdown in the Chinese economy as a result of curtailing this industry in particular, that has ramifications for global GDP growth. And I'm not sure that's necessarily priced into markets at the moment. It's no secret that the global economy is in the midst of a very strong post-pandemic recovery, but one of the elements of that is a strong China. And clearly what we've seen in recent weeks with iron ore prices collapsing, weaker Aussie dollar, weaker commodity prices per se, are all kind of giving an indication that there's uncertainty around the trajectory of global GDP growth. And again, when you look at, if you take that into account against the backdrop of markets at their highs, and the stocks that have done particularly well this year have tended to be the most cyclical. So heavy industrials, energy, basic materials, to some degree have been terrific performers globally. They're not pricing in any moderation in growth at all. So if you do start to see more moderation in growth coming out of China, I think that could be a little bit of it could be definitely a risk for those more cyclical companies.
So Ned, from Bell Asset Management's point of view then, is it worth having exposure to Chinese stocks or some exposure of any sort in China at the moment, given obviously we've just been talking about the risks there in the property sector? Moreover, I guess, indication of a slowdown in the Chinese economy and, of course, increasing regulatory intervention.
It's a really good question, and I think there's two broad ways of getting exposure to China. You can either get it through the revenue exposure of very high quality global companies, whether that's Nike or LVMH or Hermes or Apple, or you can get it through investing directly in the likes of Ali and Tencent and various other companies. From our perspective, we've always chosen to go down the path of investing in very high quality global companies with revenue exposure in China, because we feel like we're still getting that revenue exposure, but the management at the controls are, and the management teams are frankly much better quality, and the franchises are much better. We've always struggled with transparency in China's companies, and particularly things like the VIE structures, which have always been there, but there is definitely ambiguity around the legality of those structures. And then what's happened, in the last couple of months with the regulatory crackdown I don't think should come as a huge surprise, because the government did this with China Mobile about 15 years ago. So when profitability started to really spike, the regulators really started to crack down. So I think at the end of the day, what's happening from a regulatory perspective is going to definitely curtail earnings growth amongst the better Chinese companies. And as a result, we find it very difficult to get too excited about those companies, notwithstanding the fact the stocks have had pretty material pullbacks, and the multiples have contracted. The reality is that the forward-looking growth trajectory has definitely changed, and I don't think that's going to go away.
So Ned, are you saying you're pretty much avoiding emerging markets at the moment?
We have zero exposure to emerging markets. So the way we tend to think about it, Andrew, is there are various growth buckets globally you can invest in as an equity investor, and three broad ones would be large cap growth, which we all know what that is, emerging markets, and then the third one is global small mid cap companies. And frankly, that's where we find the best opportunities on the planet at the moment are global small mid cap companies in developed markets. It's an asset class it generally doesn't have that much representation in many portfolios. Long term, it's been a great performer. It's actually added about 50 basis points in alpha per annum over 20 years. And in the last 3 years, it's lagged by about 3% per annum. It trades on about a 30% discount to global large cap stocks. And really importantly, the research we've done shows that when you come out of a big earnings hole, like we've seen last year, the earnings recovery in global small mid cap stocks tends to drive periods of extremely strong performance. And just to put one number on that, so if you think about the global earnings estimates for the MSCI World Small Mid Cap Index this year, they are 47% above the pre-COVID 2019 number. So leaving aside that obvious dip last year, the earnings recovery has been phenomenal. But the actual index, it's recovered, but it's only 25% above pre-COVID highs. So to us, that's a disconnect. That's saying that the earnings in these companies are recovering much faster. And there's really two reasons for that. The first one being companies have taken a lot of cost out of their cost bases in very quick time. And then when you overlay that with effectively, great, we've obviously seen a lot of stimulus, economic recovery. So that brings with it, top line acceleration. The earnings leverage is phenomenal, and it's just not being priced in. And we think that earnings leverage has still got a long ways to play out. As your previous guest mentioned, as much as the outlook for global GDP growth is maybe being pulled back a touch for this year, a lot of that demand and that growth is simply being pushed into next year.
Yep.
So I think that further underpins the idea that the earnings leverage in this part of the market is absolutely fantastic.
Ned, we're almost out of time. Can you give us a couple of examples of those small to mid-cap growth stocks that you're investing in right now?
Sure. So a couple of the stocks that we've invested in, so there's a terrific company in the US called Yeti, which is a leader in drinkware, outdoor products. So it was founded by two brothers in Texas. I always sort of jokingly say it's a Lululemon type business about 10 years ago, but sub $10 billion, very profitable. They've been a huge beneficiary of COVID. They've had, I think their online sales have gone from 46% to about 55%. So with that comes great margins. We've also invested in companies like Thule in Sweden, which is a specialty producer of roof racks, bike racks. So they're playing on the theme of more and more outdoors type activities. And then the last one I've mentioned in the US is a really interesting company called Tractor Supply, which is a very unique retailer that operates in the rural communities. So one of the big trends as a result of the pandemic is more and more people are moving out into the suburbs and into into rural communities. They've picked up 9 million new customers as a result of COVID. So they've been beneficiaries from from various trends, and they've now got a CEO who's been in there for about 2 years, who was a young star effectively that came out of Home Depot. He's revamping the stores. So there's a lot more growth to come out of that company also. So those would probably be the three.
Ned, great to get insights as to what you're investing in that Bell Asset Management. Thanks so much for joining us.
Thanks for having me, Andrew.